Okay, so I'm going to kind of talk a little bit about what. Actually, let's back up a bit. So the topic of the talk is really I've seen quite a lot of things changing in the last 6 months with uh online business, and I kind of got excited about that and wanted to share that. So I'm going to do a little bit of a what it was like before, kind of up until I don't know 6 months ago, what it's like now, what I think the next few years will be like. Has anything changed with due diligence? If you're watching this trying to raise funds or thinking if you can, work with other people to buy businesses, what I'm seeing there. And then we'll talk a little bit about Onfolio. That's my my ask for doing this, I guess, and then the Q&A. And while this is mostly focused around buying businesses, if you're someone with a business and you're thinking about selling, um, I think it will still be useful for you to know as well. And it's not all doom and gloom for sellers. It's definitely a good opportunity for buyers, but good businesses are still in demand and will um, still fetch a good price. And I'll talk a bit about that as we go as well. Okay, so about me, most of you know me. That's why you're here. You probably follow me on social, or I think most people signed up from our email list. But since I'm going to be sticking this replay on YouTube, just in case anyone's seeing me for the first time, I'm Dom Wells. I founded Onfolio in 2018. I'm the CEO. Onfolio IPO'd in August 2022 on NASDAQ. So this is being recorded in November 23, so just over a year ago. I have participated in around 50 transactions. So those range in size from $50,000 to about 4.5 million is the biggest deal. And I say participated in because you may know Onfolio's history, you may not. But when we first started out, we worked with other investors directly to buy businesses. So what I would do was I would help them find something, help do due diligence, help negotiate with the seller and do all the migration and everything. But the investor would be the one, or sometimes group of investors would be the ones actually buying the business. So I felt like it was disingenuous of me to say I've bought 50 businesses. Um, so yeah, anyway. So before 2022, I feel like online business was kind of trending a certain way, and it didn't really get affected by the pandemic. Um, when when all the lockdowns and everything started happening around March 2020, I think there was this kind of expectation in the space that suddenly it was going to shift to a buyer's market and no one was going to be able to sell their business and all the buyers had all the power. Online business was going to die or be severely impacted. I think um, Amazon changed their affiliate rules roughly around February or March 2020, maybe even April 2020. So there were a lot of people thinking, okay, maybe valuations are going to tank. Um, what's going to change here? Or a lot's going to change here. And actually, kind of like the stock market, we didn't really see that. There was this initial dip, and I guess a little bit of an initial pause where people were thinking, well, hold on, what's going on? But we didn't see any real reduction. I know that there were some people, for example, who had businesses for sale in February 2020, and those deals fell through. But that wasn't really a shift in online business M&A. It was really just, some deals got impacted. And so before 2022, so let me just finish that story a bit more. So then during the pandemic, because there was lots of money printed, interest rates were zero, everyone was kind of stuck at home online. So online business actually boomed. E-commerce businesses in particular were thriving. Courses did really well. And then in 2021, everything really accelerated. So the stock market went nuts, crypto went nuts. FBA aggregators were buying 3 businesses a week and were paying 4.5, 5x multiples. Just everything was in a kind of bubble. And so whereas we thought 2020 maybe stuff was going to go down, actually it carried on trending up, and it maybe even accelerated, or it definitely accelerated. And so I would see a lot of transactions where even like a $2 million, $3 million transaction where it was all cash. In some cases, it was like 100% cash up front. So there wasn't much seller financing. There weren't many earnouts. Not always, but I would say there were definitely cases where I would see like a $3 million or a $4 million business, and the multiple was say 5 times or 4.5 times profit, and there would be 3 cash offers within 2 weeks or something, and it was all cash, no earnout. And that's because capital was cheap. You could get a lot of debt quite easily. People were funding just ideas rather than like profitable enterprises. And when I'm talking about multiples here, I'm really talking not so much about SaaS and software multiples, because they obviously are, well, you maybe not obviously, but software and SaaS is generally valued slightly differently, whereas a lot of online businesses are valued on a multiple of EBITDA or SDE. SaaS is usually a multiple of revenue, and that's usually because SaaS is growing very, very quickly, and maybe they're reinvesting all their profits in marketing and so on. Okay. All right. And then 2022 to 2023, I saw deals starting to fail, and more businesses were struggling or kind of returning to the norm post-pandemic. So this was when, 2022 inflation really took off and went up to 9%, I think it was, in the US. And you had the Russia-Ukraine war, and you had oil and everything, and energy prices were skyrocketing. So inflation was really coming up. And then with it, we had interest rates going up. And so deals were starting to fail and businesses were struggling. Or when I say returning to the norm, I would talk about, say, a course business or some e-commerce businesses that they had like what's known as the COVID boom, just where web traffic and e-commerce and online business was just naturally boosted by the fact everyone was stuck at home, and that started to normalize a bit. And the everything bubble had stopped, but mostly 2022 was good for sellers because buyers still had cash. So I would speak to brokers in even in late 2022, even in early 2023, and I would say, so have multiples come down yet? Because like, look at the world. And they would say, no, not really, multiples are still strong. And of course, brokers are incentivized to say that. They're not going to say, yeah, like, multiples are coming down, you don't need to pay as much anymore, because they're not doing their job if they say anything else. But at the same time, I saw businesses selling for high multiples still, so they were kind of telling the truth. And I think the reason was a lot of buyers still had cash, so there would be funds or large businesses or venture capital backed companies or venture capital firms themselves. They all had money still, and in some cases they had to deploy it, because with a fund, if you don't deploy the money within a certain time, you have to give that money back. So some players were even sort of incentivized to spend money as quickly as possible. And so it kind of didn't make sense. You looked at the public markets, which were tanking, and you looked at interest rates, which were high, and the cost of capital was high. But for most of 2020, probably early 2023, up until early 2023, I didn't really see any opportunities. And that third bullet point that says the everything bubble definitely stopped. So I definitely saw, I didn't see multiples expanding anymore. I didn't see, you know, looking at my reflection, trying to get this right, like 3x, 3.5x, 4x, 4.5x. It felt like during the pandemic, every week multiples went up, and then probably late 2021 that stopped. Yeah, and so it kind of leveled out, and then fast forward to today. I think over the last, I don't know exactly when it happened. I really noticed it probably over the last 4 or 5 months. But basically, I've noticed things are starting to shift, and we're not in a buyer's market. I don't think a buyer's market will come, because I think the economy is actually still in pretty good shape, despite the fact that it doesn't feel that way. Everything seems expensive now, but things are definitely starting to shift. So because financing has become tighter, so not just the actual cost of capital, but the availability of capital, that is now, it's partly due to what happened with Silicon Valley Bank, but I don't think it's entirely because of that. I think it's just because where we are in the credit cycle. I've seen multiples coming down. I've seen people who walked away from transactions maybe 6 months ago or a year ago, or had crazy asking prices like 4.5 times profit or 5 or something. I've seen them just coming back to the table, either to me or to just anecdotally what I've heard from others. And maybe now they're looking for 3.5x or even 3x, and they're much more likely to accept seller financing, and in some cases they are kind of offering seller financing, so you don't even have to ask. They'll just say, hey, do you want to discuss stuff? Maybe I only need 3x now, and maybe I only need 30% cash up front, which is, as a buyer, that's great. So it's really interesting, and it's kind of like, it's what I expected much earlier to happen, and I kind of had just assumed it wouldn't happen because it was going, it's like, it just seemed like, okay, the space is resistant to the world. Like the multiples are still 4x or 4.5, and then suddenly just my deal flow has changed quite significantly. And it's interesting because a lot of these businesses are still good businesses. It's not like I'm suddenly seeing desperate sellers and all these distressed businesses. I do think there is that too. But yeah, that's kind of interesting. And so let me just pause there before I talk a bit more about specific businesses. Okay, no questions other than just people saying hi, so that's good. Right, I'll keep going. So moving on a little bit, what kinds, let me go back a slide. So what types of businesses are doing well? Lots of businesses are doing well, but basically we're kind of, again, throughout 2023, we've seen a lot. When ChatGPT rolled out, like a year ago, and all the other large language models and so on, there's definitely been an impact in online business. I think it's hard to describe how big the impact has been, because in some ways I think people expected the impact to be much, much higher. I think, when everyone saw all the AI tools coming out, we all thought, oh, wow, we're all going to lose our jobs. AI is going to screw everything over, blah, blah, blah. And there are definitely businesses that have been impacted by AI. And there's even AI businesses that have been impacted by OpenAI just making everything free. Like you look at all these content creation tools that basically are worthless now because ChatGPT can do it for free. And there's, say, content agencies that people don't pay them anymore because they can just get their content from ChatGPT. So definitely many businesses have been impacted by AI. So that is something when you look at a business right now in your due diligence, you have to ask, is this business being impacted by AI, or has it been impacted by AI already, or could it still be impacted by AI, which is a much harder question to answer. But I actually think more businesses have been impacted by VC-backed clients not having money or themselves not having money. So, for example, you might know I love buying agencies, or I love running agencies and talking about buying agencies. Um, a lot of agencies, a lot of their clients may have been B2B SaaS companies or venture-backed companies, and they were doing, say, they were like, say, marketing agencies, and a lot of them, either their clients are no longer have the same budgets that they had, or their clients just kind of don't have any money anymore. And so then there's other businesses that are struggling because they were venture backed and they don't have venture capital money anymore. And I'm less in the VC space than perhaps I ought to be. So I don't know the full reasoning for this. I think it's just that VCs are telling their companies to, tighten their belts, weather the storm, and then VCs themselves maybe are not able to throw cash around as much because either they're struggling to raise it, or the same way that high interest rates affect valuations and everything. So I think that's probably having as much, if not more, of an effect on some businesses than AI. But they're both these things are in play. But at the same time, the economy actually kind of seems to be in a fairly strong place. It's the data's kind of muddy. You don't know, is a recession here already? Is it coming? Is it not coming? Has it already happened? But there's a lot of companies out there that are still printing money, and so that kind of is a fact. And so you may I think the challenge we have right now when we're doing due diligence for businesses is, sure, we have to ask ourselves, is this business going to get worse in the next couple of years if the economy does get worse, and so on? And asking yourselves, is AI going to screw this business up? But at the same time, there are still strong businesses out there that you can buy. So it's not like everything's cheap now because all the businesses are dying and you're going to be buying all these distressed assets. So, and as a side note here, I've put good businesses are still getting good multiples. So if you're a seller, this is good. And this is kind of the same with everything. So again, I'm not a huge real estate person, but my understanding of real estate is the prime location properties, like in a city center, for example, they're always going to be valuable because they're so scarce. And in the good times, they go up, and then everything further out, the lower quality real estate, the lower quality assets, they go up too because capital's cheap. People are looking for more returns. And they're like, well, I can still get returns on these inferior assets, so I'll just buy them, and then the price of them goes up. But in the bad times, those are the ones that go down first. And so, eventually the prices of everything goes down, but the really best assets stay strong. And so I definitely see parallels with that with online businesses. Like, the good businesses out there are still getting 4x or maybe 5x. That doesn't mean that everything that's 3x is a bad business. But what I'm saying is, if you're a seller and you're thinking, oh, now's a terrible time for me to sell because I could get 4x 2 years ago and I'll only get 3x now. That's not necessarily the case. You may have to accept more of a deferred payment, or some earnout or something, but there are still good businesses out there getting good multiples. And I hope I haven't just increased my buying price for everyone's business now by saying that. Anyway, so again, let me just pause a bit, see if there's any new questions come in. Nope. Okay. All right. So my thoughts for 2024 and 2025. So really, I think more of the same. I think the current trends will continue. I think multiples will probably go down a little bit, or maybe multiples of the really good businesses will start to come down. More creative structuring, and so I don't think we will ever see a buyer's market, and I've referenced that a few times. If you're not familiar with the term, it's basically right now we describe something as a seller's market because there's a lot of buyers and no sellers. So all the buyers have the power. Sorry, the other way around. All the sellers have the power. You know, if a seller says, "Hey, I want to sell my business for this," and there's no buyers, then the seller can't really do anything. They have to reduce the price and so on. So that becomes a buyer's market. Whereas, you know, a seller's market is the other way around, where really sellers can choose who they sell the business to. There's always multiple buyers. So I think we're probably at this equilibrium right now where it's not a seller's market. Sellers are definitely getting a lot more nervous. They're being more accepting of lower multiples and better structures. But it's not like the power has shifted all the way to the buyers. And I think in 2024, 2025, we'll see the same unless the economy really tanks and just nobody has any money and all these businesses are terrible, that people are just trying to give them away. Like Florida real estate in 2008 or something. That might happen, but not my expectation. But I do think it'll become easier to evaluate businesses because part of the challenge of evaluating businesses over the past 3 or 4 years is, pre-pandemic, everything was kind of easier to evaluate. And then during the pandemic, you're asking yourself, is this going to get impacted by the pandemic? And then in 2021, you're looking at a business and it's booming because of all the online stuff and all the pandemic COVID boom. Then you're asking yourself, is this business going to stay booming, or is it going to kind of revert to the mean if this pandemic ever ends? And then when the pandemic ended, you're looking at it and it's coming back down and you're saying, okay, is this just a reversion to the mean, or is this the new normal? A business was making, let's say, $2 million last year and it's making 1.5 now. Is 1.5 the new level, or is it going to keep going down to 1.2 or 1.1? And then you look at a business in 2022 or 2023 and it's the same. Like, is it going to continue declining, or is this the new normal? And so I think in 2024 and 2025, it'll be something where businesses maybe have a new normal. And so, something will have found a bottom. Maybe it will have been holding steady for 2 years, and you'll be able to say, okay, this is probably what this business is going to earn for the next few years. So, of course, every business is different. Some of them will be trending up, some of them will be trending down. But I think there's a lot. It's kind of like the anything over the last 4 years, you really have to ask yourself which of these last years is representative of where this business should be earning, which is quite challenging. I think capital will continue to be scarce. So that's great if you have it, because your competitors probably don't. And so, there's a lot of like inflation rate and interest rate predictions out there. So I don't really know what my prediction is, but I don't think we'll see capital becoming readily available and getting thrown around in this space again until, say, interest rates go down to, say, 3%. And we're at what, like 5.5-ish now. So what's that going to be? Late 2024, probably, maybe even 2025. And so I think we'll see the same pressures we've had on businesses that have lowered multiples. I think we'll see that continuing, which is good if you're, well, good and bad. I'd like to have more capital, but also I quite enjoy multiples being lower. So it's a bit of a catch-22. I guess it balances out. So interestingly, though, eventually multiples will go up again. So if you can buy a business in 2024 for 3x and sell it in 2025 or maybe 2026 for 4x, plus the fact you know the business will have been earning while you've been holding it, that's a pretty good opportunity. Okay, I'm just gonna have a drink of water. All right. Okay, due diligence considerations. So I talked a bit about this just now, but what else? Hold on, I just saw a question come in. Yeah, let me go back a bit. So someone threw in a question just then, thank you, which I'll read out the question because I know nobody else can see it, but a good to answer that question before moving on. Marlon, thanks for the question. With interest rates not budging for a while, don't you think brokers and sellers need to accept this and be more open to seller and creative financing, especially in the small to lower middle markets? Otherwise, the pool of sellers get very small. Yeah, I imagine the pool of buyers get very small as well. So yeah, I mean, I said here people may need to get creative. I guess I was referring to buyers and sellers here. I agree. I think this is what I'm starting to see as well. So um, a lot of my deal flow is off market now. So a lot of the founders I speak to about buying their business, it's come from a personal network or a LinkedIn connection or um, direct outreach, that kind of thing. And definitely there, I'm seeing people just being a lot more creative. So I thought I had it in the deck to talk more about some of those examples, but for example, we've got some deals in our deal flow where um, maybe the multiple is 3x or 3.5, and the seller is willing to accept, say, 30% cash upfront. And then for us, we have preferred shares, so we can issue them some preferred shares. And then the rest would be an earnout or a balloon payment. And I think, yeah, we're starting to see that now. Brokers, it really varies. I think brokers who are kind of individual brokers, they are probably advising people, their sellers, the same way because they just want to get the deal done. I think brokers with a bigger reputation um, maybe are less likely to do that. And I think there's two or three reasons for that. One is they probably have the biggest buyer pool, so maybe they're going to be the last ones to need to do that or to kind of admit that it's necessary. And two, um, because they have a big reputation, they want all the sellers to come to them. They're going to be still keeping prices higher so that they get that, that sort of inventory. And also perhaps, I think they're professionally, they feel they'd be doing sellers a disservice if they start encouraging sellers to take those kind of terms. Whereas, I think my perspective is you've got to advise your sellers accordingly and do what you can to get the deal done. So, no point being stubborn about it. So I think it really varies. But yeah, I do agree with you. Okay, another question came in. I think I'll save that one for a bit later on, but thanks for that one. Okay. So now when it comes to due diligence, has anything changed? Again, I think it's really beyond the scope of this chat for me to give like this long due diligence checklist and say everything you need. So I really just wanted to be talking about, apart from the usual stuff, what's different. And so the usual stuff would be, what's the trend of the business? What are the finances? What is the reliance on the founder? What is the risk of the macro environment changing, affecting the business? What are the competitors doing? All the usual things. Whereas there are a few new ones. So we do ask ourselves, will this business grow over the next few years? That's not really a new one. I'm not sure why I put that in, but I guess um, I think it's a more important question now because there is so much upheaval than in the world right now. It's less of a like, sure, the business will grow, and more of a, well, actually, can we really reliably say that? I think, will AI hurt this business or potentially help it? Some businesses can be helped by AI, particularly some service businesses. AI can replace some cheap labor. Um, does the changing SEO landscape help this business? Um, I think I probably should have put hurt there. Does the changing SEO landscape hurt the business? Definitely. And will increasing CAC hurt it, which is customer acquisition costs? So Facebook ads and Google ads and so on are more expensive now. That's partly because the changes that Apple's made to privacy make it harder for their algorithms to reliably find a customer, so it costs you more to find them. So basically, the ads are less efficient. It's not because buyers are necessarily there's more people buying ads or anything. So yeah, how about funding? So most people here, I'm just making an assumption that most people here are individuals looking to buy a business for themselves. So the funding scenario is going to be different for everyone. So I don't want to dwell on it too much, but I do think it's important to talk about because got a typo there in my title, because I think the bigger picture on funding does affect the market as well. So it might not be relevant to an individual who's got 50K that they want to invest in a business, whether big private equity firms are able to get capital, but it does affect the multiples and the competitive space and everything. So I think it's still worth talking about. So SBA loans, which obviously if you're in the US, and SBA loans an amazing thing. If you're outside the US, it's just something you get jealous of. I know I've experienced that. SBA loans are pretty expensive now. They're about 11 to 12% interest. I think it's prime plus 3% or something like that. So last time I calculated it, it was about 11.5%. So it's still a potential option for a business which might return you 20%. But bear in mind, it's usually I think it's a 4-year amortization. So you're not just paying the interest, you're also paying back the principal. So they also come with a personal guarantee. And so if you're thinking about using an SBA loan, you can, and the numbers just about work, but you need to be very careful because you can become underwater fairly, something goes slightly wrong and now you're not cash flow positive. So other capital is also expensive or not available. It's hard to get banks to lend money for acquisitions right now. It's especially online businesses. It's hard to get a lot of other financing, and so that's affecting really the space, and it's trickling down. So if you've got a lot of dry powder, this is an advantage because you might be one of the most well-funded people in your space, or you might just have the ability to put a little bit more cash into a deal or buy a bigger business where, let's say you have 500K you want to invest in a business. In 2021, you may have been able to buy $1 million business for that. and pay 50% upfront and the rest over time. Now you could probably buy a $2 million business for that. And so that's interesting. Now, there are people out there who are thinking, okay, I've got skills in operating online businesses. I want to know actually what options are there for me? Like, how can I get funding? So I have some suggestions. And again, this could be an entire topic for a different webinar. Maybe actually I will if people are interested. But I think what you can do is find people that do have money. There are people out there that still have capital to invest, and if an investment makes sense. So you could raise capital via an SPV, which is special purpose vehicle, basically a dedicated like Delaware LLC or something like that, and you raise money into that. And then what's interesting is because sellers now are taking a lot less cash up front, you could, let's say you could put in 5%. So let me do some actual napkin maths. Like, let's say there's a business that is $1 million business and the seller's willing to take 300K up front and the rest over time. And you look at the maths and you think, okay, the business can support those over the time payments. So I don't need to put any additional cash in. The business can kind of pay for itself. So, maybe you need to put in 5K or 50K yourself to make it work. And then you could raise 250K to pay for the gap between what you're putting in and then what the seller wants. And then maybe instead of giving the equity holders, let's say they've put in 250K into $1 million business, so that's 25%, you could give them 20%, and then you've got to keep 80% and you've only put 5% down, something like that. And we've done deals like this in the past. The tricky thing is most sellers in the past didn't want to take a seller note, so it was not always possible for us, whereas now we can definitely do that. And so I don't know, I just laid something out and made it sound easy, and most people might be thinking, yeah, cool, I don't know anybody with 250K, or how am I going to find people? And that's why I said this is really a topic for a different webinar where I could do a whole dedicated thing on that. But basically, if you know people who are looking to make investments and you find a deal that you think makes sense and the seller's willing to take a note or an earn out, and you could potentially raise capital that way. So that's one thing. Where are we at? Okay, 45 minutes, nice. My fear was it would be 10 minutes and then done. Like, thanks everyone for coming, see you. Okay, so I've got some final thoughts and then some final thoughts. So really, if I could summarize anything, I think now is a good time to be a buyer. Yes, capital is tougher to access. You might think twice about taking an SBA loan or some other loan, but I don't think there's been a better time to be a buyer than now. Businesses are still profitable, so you can still find something good. You don't have to worry about dealing with a distressed asset. A lot of the kind of shit hit the fan type stuff that can happen in the world has already happened. I'm sure there's more. I'm sure the world's got more stuff to throw at us. But when you think about Ukraine and Israel and inflation and what else, I'm sure there's more that can happen. There's an election coming up in the US. There's still a lot of uncertainty, but it's not like you bought a business in 2021 with a personal guarantee and then all of this stuff happened. I think that would be way worse. I feel like people are a lot more risk averse now. They understand all this crazy stuff can happen. So I think it's actually a better position to be in buying business now than say 2 years ago. And we're not at the end yet. Like I said, I still think there's bad things that can happen. but yeah, that's kind of my thought there. Maybe I'm just being optimistic. So overall, I'd say I think it's a good time. I think sellers are being more flexible, being more reasonable. I think there's deals still to happen. Um, Perhaps I'm seeing stuff that others aren't because I've got a lot of like private deal flow. But I do think what I'm seeing is representative of a much bigger trend and a shift. I don't think it's just because I'm putting out good LinkedIn content. I don't think it's that good. Okay, so final thoughts, and then we'll go to Q&A. So basically, my last sort of motivation for doing this was um, Onfolio's got a ton of deal flow. We don't have enough capital to bring it all down. So in the past, we've been raising money from debt or from preferred shares, but I think a lot of people are more interested in kind of co-investing with us. Um, so, for example, let's say we have a business for it's worth $1 million. We need 200K to close it. We would bring investors in to help fund that 200K, and the ROI should be a lot higher than preferred shares. So, I'm not going to make any promises here, but if anyone's interested in that, you can just email investors@onfolio.com with the subject JV and put whatever you want in the body of the email. Questions, or just send a blank email with JV as the subject. But yeah, that is something we're exploring, and I think it will be a pretty good opportunity for some of our people who weren't really interested in, say, getting a 12% dividend from a preferred share, but are interested in co-investing with us. So that's my sort of thanks for listening. Here's my timeshare pitch. Now Q&A. I've got one question already, which I'll get to in a sec. Feel free to type more. If you're watching the replay of this, it's on YouTube, so you can type comments there, and I will check the YouTube channel and get back to you. If you want to ask like a non-public question on YouTube, you can just email dom@onfolio.com, or just email me about anything. Twitter, Dom Wells Onfolio. And also onfolio.com/newsletter is where my newsletter is. So, okay, so one question came in. I'm going to answer that. Thank you, Christine. And if anyone else has any question, just type it in now and I'll get to it. So Christine's question was, given the big HCU updates by Google this past month, would you personally invest in a content site whose revenue comes from display ad and affiliate? So for those not in the know, HCU is Google made a Google update called the Helpful Content Update about a month ago. And then they made another update like a week later, and then they made another update yesterday. So they like their updates. Basically, I mentioned a few slides ago that the SEO landscape is pretty unpredictable right now. So I probably wouldn't invest in a content site whose revenue comes from display ad and affiliate unless it wasn't heavily reliant on SEO, and most of them are heavily reliant on SEO. But for example, let's say it has a big email list, a big social media presence, lots of direct traffic, maybe even paid traffic can work, then I would consider it, sure. Like if it was an actual brand, sure. But if it's the kind of sites where maybe 90% of the traffic comes from Google, I would probably not, just because it's so unpredictable right now. It's really hard to evaluate. And so I talked about this on LinkedIn a couple of days ago, and somebody strongly disagreed with me, which is fine. But I think the issue is not really whether or not content sites, whether you can make money investing in them. It's how reliable is it? When you're looking at a business and you're asking yourself, will this business die, or will its income tank over the next 6 months with a content site? I just find it really hard to know the answer to that question, which makes it a difficult investment. But I'm sure some people can make it work. I wouldn't do it. Okay, so two more questions came in. Oh, lots more came in. Okay, what kind of businesses are you looking to acquire in 2024? There's kind of three buckets, but we wouldn't stick just to them. One of them is agencies, so B2B marketing agencies. What else? Yeah, usually B2B marketing agencies. So maybe email marketing or SEO or paid traffic, that kind of thing. Another would be software, but our main skill set for software is kind of around the WordPress ecosystem. So we don't have big in-house tech um, development functionality. So buying like a proper SaaS business might be a challenge for us. So that kind of WordPress software. And then the other type is courses. We still like buying online courses. Um, the good thing about courses is the big issue with courses is often they're reliant on the founder or the course creator to either teach the course or be the face of the course or do all the biz dev. So you just kind of don't buy those courses. But there are other courses out there which are great and they're very high margin. Usually they have a good paid traffic funnel, but you can usually improve it. They have great audiences. And so, yeah, we like courses. Um, so those are kind of the three we're targeting, like agencies, some WordPress businesses, and some courses. Um, but I think we would still evaluate, say, like a marketplace or an e-commerce business. Maybe we would look at some content if it had all of the other features that I was talking about, so it wasn't just reliant on Google. And um, yeah, I would also say don't just do what we say. I mean, if you're really good at software, go with software. So that's what we're focusing on, but not necessarily what everyone should focus on. Joseph, would preferred shares be similar to the traditional preference shares? Would they be cumulative in case during a particular year there wouldn't be enough profits to pay the 10% rate in full? It's 12%, not 10%. But yeah, they accumulate. So if for some reason we had to defer the payment one quarter, then it just accrues to the next quarter. Another one. So a couple more questions came in. Based on Onfolio's cash on hand at the end of last quarter, why are you looking for JVs to help fund purchases? Because as well as our cash position at the end of the quarter, we also have a 2.5 million seller note due this month that we're going to pay off. So that will take a big chunk out of our cash position. So we'd rather co-invest. So we'll still put our own cash into some acquisitions, but if we have, say, 10 acquisitions in our deal flow and we can only afford 3 of them, we're thinking, okay, what other ways can we afford all 10 of them? And so that's a way of doing it without depleting our cash reserves too much, basically. Thomas, I will be sending an update probably next week about that. So I know I've been saying that for a while. Marcus, once you acquire the business, what does your 100-day plan look like to start creating value from the start? Yeah, that would also be a great topic for another one, but I'll try and answer as best I can now. The 100-day plan really depends on the business, but we're trying to answer this as much as we can while we're doing the due diligence. So we're asking ourselves, obviously, what are the risks and is it a good value and what do we do if some key people leave and all of these things. But we're also saying, what are we going to do for the first, I think we focus on 90 days and it varies, but it's usually the first sort of 30 to 60 days, really, you're not trying to do too much radical changes to the business because you want to know if the business starts declining, what was the thing that maybe led to it? Like, was that activity that you thought should be stopped was actually more impactful than you realized, and so on. So It's really, okay, making sure the transition has gone well. Have you taken over the business? Have you transferred everything well? Have you um, forgotten anything? And, have you made a plan? And then usually it's picking one or two things that you think are going to be the most impactful and focusing on them. So I'll give some examples. Um, a lot of the time, there's some quick wins that you can have with the email list. So sellers often during a transition period, which could be a few months, they kind of take the foot off the pedal a little bit and they don't bother, say, contacting old customers or sending sales promotions. Sometimes they do too many sales promotions because they want to kind of boost the numbers a little bit. So you have to be wary of that. But often we'll come in and let's say, so for example, when we bought Content Elect in January or February 1st, we took over. Um, the first thing the new CEO, Jason, did when he took over was just email old customers. And sometimes it was like a blast email, like going out to the entire list. Sometimes it was targeted and emailing old customers and old leads. And I think we had a really strong month, February and March, just because like he did that. Um, then you might look at things like, okay, uh, during due diligence, you will have uncovered like, okay, maybe the prices haven't been put up for 6 years, or maybe there's some things broken in the email funnel, or the website has some things that need improving. Maybe there's a new service that we could offer. Maybe we have a business with similar audience and we can cross promote. So you would identify these things during due diligence, and then you would just kind of say, okay, which one of these things should we fix first? But then after 90 days, that's really when the real plan starts, because you found out all the things that broke during that first 90 days, or uh, these theories you had during due diligence, maybe they didn't pan out. So really, it's like, what do you do the second half of the year, or the next few months, where you go, okay, that thing didn't work. I emailed all the clients, didn't get any money. What do we do now? So um, yeah, that's also an important part. The first 90 days is figuring out everything so that you can, then sort of start the real plan. It's like, again, buying a house and you come in and you find out half the light fixtures aren't working. So then you have to go off and deal with that. Yeah. Okay, so what advice do you have to newbies who are looking to buy SMBs now? Any thoughts on how to be effective on finding a business without private deal flow? Well, first of all, I think anyone can start to build private deal flow. My private deal flow is a result of me putting out content and people just obviously I've been around for a long time as well, so people know me and they reach out to me and stuff. But there's nothing stopping people from networking. Maybe they have friends who have businesses and they say, do you know anyone that's looking to sell? And maybe the friend does know someone who's looking to sell, or maybe the friend wants to sell. And sure, you're going to have to kiss a lot of frogs this way, and you're going to, it's a numbers game for sure. But I think you can do that. As well as doing that, you can look at all the marketplaces. So, Empire Flippers, FE International, Quiet Light, website closers to some extent. There's a few others, acquire.com. Did I say Flipper? There's Flipper. And you might not necessarily find something there, and it's probably going to be a more competitive environment, but you'll get better at identifying businesses and evaluating them and negotiating and figuring out what you don't know. So it's not just about having good deal flow, it's also about kind of having good abilities to actually understand like whether you can even do due diligence on a business. So it's really it's this thing where you kind of have to rush because there's a lot to learn. So the sooner you start, the more you learn. But like, you absolutely shouldn't rush in buying a business. So it's massive action, really. One thing I've seen people do sometimes is they'll post on, say, their Facebook or their LinkedIn and say, "Hey, I'm looking to buy a business. Does anybody have any referrals for me?" I've actually seen some people succeed that way. You kind of need to, uh, because you're kind of tapping up your warm network there, like friends and maybe referrals from friends. You have to have some kind of benefit. Like, either maybe you're really good at growing businesses and you say to someone, "Hey, I want to grow this business. I've got loads of skills." Maybe you have access to capital. um Probably you're not going to get anywhere if you're just like sort of kicking the tires. If you're just doing that and trying to learn, then I would probably stick to marketplaces and brokers and stuff, and listen to the podcasts that they all put out. I think that was the last question. Cool. I'll just wait a couple minutes in case someone's mid type. How did we do? About an hour. Nice. Um, okay, just wait another minute. So yeah, the just saw another question come in. Cool. So just before I answer that one, I'll put the replay up on YouTube. Um, I'll probably edit it a bit first, like get rid of the opening few minutes of silence while I'm waiting for everybody and stuff. So might take a few hours before it's online. But yeah, I'll put the replay up there, and then again, if you think of a question afterwards, you can email me, talk to me on Twitter, comment on the YouTube video, and so on. And oh yeah, the other thing was, I don't know how often I'm going to do these, but quite I hopefully enjoy it. So for example, maybe I could do one of these a month. Probably be silly to try and commit to more than that. So if anyone's got any thoughts on, what should we do next, um, I'm all ears. Like, I could do something about due diligence. I could do more. I could dive in on any of these topics we've covered in more detail. Someone suggested, why don't you do something about how to take a company public? And I don't think that would actually appeal to that many people, but it doesn't have to be one of the topics I've spoken about today, basically. So yeah, I don't know. Leave comments somewhere if you have any ideas, but I'm definitely open to suggestions for doing more of these. Okay, so that question that came in was, thanks, Ed. Appreciate it. Okay, so Sam, how do you think we can use AI to expedite services or tasks? Would you searchers wait, would help you or searchers or help them be more effective at getting deals done? How can we use AI tools to expedite the due diligence period? Um, yeah, I actually started building an AI tool to kind of help with due diligence. But you kind of get busy doing all these other things, so I haven't finished it yet. But so far, I've actually found ChatGPT is fairly good at analyzing um, uh, financial charts, especially since they rolled out the what is it, the code interpreter version. So I wouldn't rely at all on ChatGPT's analysis, but it can help point you in the right direction. So, for example, let's say you have a business's P&L, and you can eyeball it. You can see, like, oh, okay, yeah, this is trending down or that's trending up. So you don't need ChatGPT to tell you that, but you could upload a P&L to ChatGPT, obviously if you have permission, because a lot of people don't want their stuff uploaded. But um, and then you could say, what can you observe about this business? I'm thinking of buying it. What questions do you have? And it actually is quite good at saying, like, why did the marketing spend decrease 3 months in a row here. And you can even role play with it. You can say, hey, you're a due diligence robot. Ask me 7 questions or find 7 things that you want to know. And I was kind of using it just for fun, I guess, to see if it was actually any good, but it was surprisingly good. So I think I said something like, ask me questions about the P&L and then ask me follow-up questions based on my answers. So I think I pretended I was with the seller of the business. And so it said something like, why did the marketing decline for 4 months? And is that the reason that top line revenue declined? That kind of thing. And then I said, oh, marketing declined because we ran a Facebook ad campaign that was unsuccessful and decided to stop or something. And then it asked a follow-up question saying, I can't remember now, but it was something like relevant to it, like what how much did you test the Facebook campaign or something like that. And then it asked me another one about why was there a spike in revenue in November, and I said Black Friday, and it said what did you do, what kind of campaign did you run during Black Friday, like how repeatable is that, could that be run later in the year successfully, stuff like that. And so it was really interesting because I don't think you could just upload a P&L and some, like a prospectus to ChatGPT and say, hey, should I buy this business? But it can definitely give you questions that you should ask. And it can also draw graphs and stuff. Like if it was a SaaS business, it can draw charts about, it might say, hey, this business is losing 10 customers a month and it's gaining 12. So it's growing, but like not very quickly. It can also do observations about gross margins and stuff like that. So yeah, you could definitely use AI to help with that. I don't think, I'm trying to think if there's any other examples. What the tool I'm trying to build is basically like a tool that will ask these questions for you, because with due diligence, it's always the same. Like, how much do you pay yourself? What is this line item about? You said your cost of goods are this. What goes into cost of goods? Why don't you have any insurance? Or it's always the same questions, and it's a waste of time for the seller and it's a waste of time for the buyer. So having like a predetermined AI tool that would ask these questions for you, so that then you can just read the answers and it's a lot more efficient. Now, would the AI tool be able to make you a recommendation on whether to buy the business? Probably, I'm sure it would try, but I don't know if you would want to listen to it. But it could speed up the kind of data gathering and data analysis, definitely. And I think ChatGPT out of the box can do a lot of that. So that's actually kind of interesting. You could probably also just get it to summarize a bunch of stuff. Like you could probably share a few different business listings with it, and it can browse, and you can say summarize these ones and do stuff like that. I haven't tested it to do that, but yeah, you could probably do that. Maybe it could even analyze code. I'm getting too many ideas now. All right, but yeah, I think that was the last question. Hopefully, I haven't freaked everyone out. Oh, one more came in. Okay. Yeah, no problem. Yeah, feel free to email me, Sam. Great. All right. Thank you everybody for coming. I really, I said in one of the emails, please come and bring questions, because I think the more questions you ask, the better the session goes. So I really appreciate everyone coming. I think we had about 40 people at the peak, which was pretty cool. So yeah, thanks everybody. And yeah, see you in a future one.